Hi, this is Patrick Vernon from UNC Kenan-Flagler Business School. In this VCIC training video, we will look at how venture capitalists do their job, starting with raising a fund. In the last video, we defined venture capital as institutional, private equity investments in high-growth startups. Institutional refers to the institutions from whom the capital flows through the VC fund to the startups. When looking at how VCs do their job, I think it's easiest to break it down into three components. First, they raise the capital from institutions, their limited partners. Then they put the money to work by investing in startups. And lastly, they grow those startups and return more money to their LPs. I like to call this the VC job cycle. While VCIC focuses on investing in startups, your team needs to understand the full cycle to perform well in the partner meetings. This video will focus on fundraising. VC firms and funds are both set up as legal entities called partnerships. The general partners are the VCs, and the limited partners are the institutions or other investors who have limited liability and limited participation. They just supply capital. Everyone is aware that startups pitch to VCs for funding, but most are surprised to find out that VCs go on a very similar roadshow to pitch to institutions for their funding. Just as entrepreneurs will pitch to lots of VC firms and piece together a round of funding, VC firms also pitch to lots of institutions and piece together a fund. And just as founders pitch an amount of money they're raising in their strategy to hit milestones, VCs pitch an amount of money they're raising in their strategy to invest, which will include the types of startups they intend to have in their portfolio and the average investment in each startup. For example, imagine you and a colleague are starting a new fund, so there'll be 2 GPs. Let's estimate that you each could do 2 new deals a year, or 4 total for the firm. Over 5 years, that would be 20 startups in your portfolio. If we target $5 million per startup, you would need a $100 million fund. The algebra here is not difficult, but your team needs to really understand these variables. For example, $5 million total for each startup indicates very early stage. Looking at typical rounds of equity investing, with only $5 million per startup, we would have very limited participation in Series B or later rounds. You would lose your VCIC event, for example, if you had a fund profile of $100 million and you proposed an investment of $10 million in one startup. Here's an example of how you might break down a VCIC fund profile. This is not the right answer, it's just one way you might do it. Feel free to pause the video and take notes. So VCs are pitching their fund strategy to numerous institutions. Once they have enough commitments to meet their fundraising goal, the fund is closed, meaning it's closed to new LPs. However, it means it's open for investing in startups. And it also means a clock will start on a 10-year life. I mentioned above that firms and funds are partnerships. Firms are like a holding company and they have no time limit. Funds, on the other hand, have a 10-year lifespan. That 10-year lifespan represents significant constraints for our investing. We only have about 5 or 6 years to find new startups in which to invest, to give ourselves any realistic chance to grow the startup and exit before the 10 years are up. Once we do find a startup and we're ready to invest, it's time for a capital call. When we raised our fund, each limited partner pledged a certain amount, representing a certain percentage of the fund, but no actual cash was transferred. When we're ready to make a $1 million Series A investment, for example, each LP will wire us their percentage. This represents a challenge to our LPs when determining their IRR from these investments. Not only do we have an unusual hits-driven strategy, the money is not all put to work at the same time. You might wonder why institutions would sign up for this, considering how important consistent returns are for them. The answer is the scope of the hits. For a relatively small bet, the returns can be enormous. Since these are private transactions, we don't know all the details. But even if these numbers are off by an order of magnitude, the impact is quite dramatic. Bonus question. What might an LP of Sequoia or Kleiner Perkins get back in returns from the funds that included Google? I'll let the curious pause the video and read this. The rest of us will move on. Back to our 10-year fund life, if we intend to be in business for a while, we'll need to raise more funds. Specifically, it will be imperative to raise more funds before year 6 when we run out of cash for new startups. I think it's fair to say that after the first couple of years, VCs are always fundraising, always investing, always growing, and always exiting. If the judges give you a hard time at VCIC for missing some due diligence, tell them you are meeting with new LPs for Fund 3. Quick recap, one VC firm will raise multiple funds. Each fund will have a 10-year life and its own set of LPs. Something else to note is that successful VC firms tend to raise bigger and bigger funds over time. This happens for a few reasons. Most importantly, it's because they can. Track record trumps strategy when it comes to pitching to LPs. The fee structure also creates incentives for bigger funds. VC firms charge their LPs a % of the fund size for managing the fund. These fees go toward things like salaries and rent and travel, and you can imagine you can do a lot more with an extra $8 million in your operating budget. But it is the carry where the venture capitalists have the opportunity to make the most money. This is the splitting of the proceeds between GPs and LPs once the fund has been returned. Once again, let's take a look at Google as an example, but be aware this is an extreme example. Let's just look at Sequoia's participation, and let's guess it was from Sequoia 8, their 8th fund, which was a $300 million fund. Assuming they did receive $2 billion in proceeds, first they'd return the $300 million to their LPs. Then they would split the remaining $1.7 billion 80-20. That would result in $340 million for the firm's general partners. There is an industry standard 220 fee structure, but this is entirely negotiable between GPs and LPs. Premier funds can charge higher fees and generally have LPs lining up to get into their next fund. The incentives to raise bigger funds is clear, but what is less clear is the chance for success of a larger fund, as it implies a new strategy. If we have more money to put to work, we're going to either need to invest in more startups or go later stage. Either way, this does represent a shift in strategy for which we had a proven track record. As an example, let's look at fundraising for one of the most successful venture firms of all time. For 30 years between 1980 and 2010, there is a clear upward trajectory despite some boom and bust cycles. These are classic VC funds titled KPCB 1, 2, all the way to 17. After decades of increase, there has been a decrease in traditional VC funds. But before you start feeling sorry for Kleiner Perkins and their decreasing fees, things look a little different when you add their specialty funds. This speaks to a trend in the venture capital industry over the last couple of decades, away from the traditional generalist fund that would invest in all types of technologies, towards funds that have a specific focus. Perhaps related to that trend is a bifurcation in the industry, leading to a proliferation of micro and mega funds. There's also been a trend, led by Andreessen Horowitz, of funds that are considered by some founder-friendly. These trends are generalizations largely dictated by California. Your team should check out the trends in your region. In this video, we covered the basics of venture capital fundraising. Here are some terms and concepts you should be familiar with before you go to your VCIC event. In the next video, we'll discuss how VCs put the money to work investing in startups. This is Patrick Vernon. I'll see you next time.